It's no secret that getting a discount on a home in the Greater Toronto area has become the new normal. These days, a 10% price drop off the original asking price barely even raises an eyebrow. But what if I told you that for the smart buyers, that's not even where the real negotiations begin? The new reality that agents are seeing on the ground, the one that's forcing sellers to get serious, is that confident buyers are now demanding an additional 5% off at the 11th hour just before the deal is signed. It's a bold make or break demand that is completely flipping the power dynamics in the GTA. This isn't just an aggressive lowball, it's becoming a price of entry for the sellers who actually want to get a deal done in this market. In this video, we are going to break down the hard data from January 2026 that proves that this market has completely swung in the favor of buyers. We will look at why this plus 5% trend is happening, and most importantly, I will give you the playbook for what it means for you, whether you are trying to buy or struggling to sell. Anyone telling you that this market is just balancing is being way too polite. The market hasn't just been balancing, it's lurking completely into buyers' favor, and the latest data from the Toronto Real Estate Board and for January 2026 makes this crystal clear. Let's start with the most critical numbers: sales. In January 2026, only 3,082 homes were sold across the GTA. To give you some perspective, that's a huge 19.3% drop from January of last year. Sales haven't just slowed, they've fallen off the cliff. We are seeing activity at historic lows, which creates a massive problem for sellers when you look at the other side of the coin: supply. Active listings, which is the number one of homes for sale, have climbed 17,975 properties. This tidal wave of supply meeting a drought of demand leads to one metric that truly defines a market: months of inventory, or MOI. With sales so low and listings so high, the GTA is now sitting at a staggering 5.8 months of supply. For context, anything over 5 months is considered a firm buyer's market. At nearly 6 months of inventory, it means that not even a single new homes were listed. It would take almost 6 months to sell every property that's currently on the market. That is the kind of environment where the buyers feel zero pressure to rush. They have all the time and all the choices in the world. We see this reflected in the average days on the market, which has now swelled to 45 days, a 21.6% increase from a year ago. Gone are the days of 24-hour bidding wars. Properties are now sitting and sitting and sitting. And every single day a property sits, the seller's anxiety grows and the buyer's leverage gets stronger. With sales in a deep freeze and inventory boiling over, the inevitable result is intense pressure on the price. We aren't just seeing a little softness, we are seeing major year-over-year declines right across the board. The overall MLS Home Price Index composite benchmark is down 8% from a year ago. Now let's look into the condo market, which for years was seen as the most suitable entry point for the GTA into the market. The average price for a condo has plummeted by 9.8% year over year, now sitting at just $604,759. TREB has noted that elevated supply is giving condo buyers in particular significant negotiating power. This is a huge shift. Investors who are very sensitive to high financing costs have already stepped back, leaving a glut of inventory on the market with very few takers. And what about the king of Toronto real estate, the detached homes? Even this segment isn't immune. The average price of a detached home in the GTA has fallen 7.4% year over year to $1.277. The bottom line is that no matter what you are looking to buy or sell, From a downturned condo to a suburban detached house, prices are heading down. There's no safe haven in this market. So with prices officially dropping and inventory piling up, how are the buyers behaving in the trenches of the negotiation? This is where we are seeing what I call the plus 5% phenomenon. The official data already gives us a huge clue. The average selling price in the GTA is now $973,289, a drop of 6.5% from a year ago. This means that on top of any initial discounts, prices are still falling. But here's what's happening on the ground. A house is listed for $1.3 million, already down from what the sellers hope to get. It sits on the market for 45 days, the new average. A buyer seeing the seller's patience wearing thin comes in with an offer. After some back and forth, the sellers are thinking of a price of maybe $1.25 million. The sellers are relieved, they just want to move on. The contracts are drawn up, but right before they are set to sign, the buyer's agent calls with a final message. My clients have been watching the market, and with the prices down 7 to 8% year over year, they are nervous. They are ready to sign today, right now, but they need the price to be $1,087,000. That's it. That's the market drop plus the extra 5%. It's a calculated take it or leave it. The sellers is now forced with a brutal choice: accept the new lower price and finally be done with it, or put their house back up on the market with nearly 18,000 other listings. More and more sellers are reluctantly taking the deal. This isn't just an aggressive tactic. It's a buyer's pricing in their own risk. They see benchmark prices falling and they are building themselves a safety cushion. Their confidence in the market's direction is shaken, and they are demanding to be compensated for the risk of buying on the way down. If you found this information helpful, please hit that subscribe button and turn on the notifications. For buyers, this is the moment you have been waiting for. But having leverage and knowing how to use it are two completely different things. Here's your playbook for 2026. First, you have to ignore the asking price. In this market, the listing price is just an advertisement, a hopeful number the seller is started with. It is not a reflection of value. Your agent should be pulling the most recent comparable sales, not from last month, from last week. And you should start with your analysis there and then subtract. Second, you need to weaponize the days on market. That 45-day average is your best friend. A property that has been sitting for 30 days, 60 days, or even 90 days has a seller whose motivation is growing every single week. Your offer should be inversely proportional to their patience. The longer it's been listed, the lower your offer should be. Third, your initial offer should be strong, but 5% less and backed by data, and it doesn't have to be your final offer. This is the plus 5% strategy. It's not about being a bully. It's being pragmatic. You are protecting your investment in a market that's clearly still declining. Now, for the sellers out there, this is a tough message to hear, but you absolutely have to understand that if you want to sell your home, the price your neighbor got in 2023 or even 2025 is completely irrelevant. In this market, it is gone. Your number one enemy is denial. The price you want is not the price the market is willing to pay anymore. In a market with nearly 18,000 active listings, every week you hold out for your dream price, more and more homes pop up for sale around you, making your property look older and more stale. You are in a race for the most realistic price, and the winner is the one that gets there first. You have to understand there are two prices in this market: the price that gets you a few showings and the price that actually gets you a written offer. Right now, those two numbers are very far apart. My advice is to be brutally realistic. You need to price your property so aggressively from day one that you stand out from thousands of other homes for sale. If you are not the absolute best value in your neighborhood, you will be completely ignored. Buyers have way too many choices to waste their time on a wishful seller. You either adapt to the new reality of buyer demands or you become another statistics for the ever-growing days on market column. So let's wrap this up. In January 2026, data points a very clear picture from a market deep in the buyer's territory. Sales have plummeted by over 19% year over year. Prices are falling right across every category, with the average condo market taking nearly 10% hit, even detached homes falling over 7%. And most importantly, the power dynamics has completely shifted to much buyer who are now confidently making the last-minute demands to protect themselves from the further price drops. This isn't an insult, it's a rational market response when there are nearly 6 months of inventory sitting for sale. The big question is, how long will this last? Toronto real estate suggests that the price weakness will likely persist for the first half of the year, with a potential for things to stabilize in the second if consumer confidence returns. But for now, the trend is clear and is pointing down. I want to know, what do you think? Are you seeing this on the ground? Do you believe that this deep buyer's market will last a whole year, or do you think rate cuts or some other factors will spark a recovery sooner than people expect? Drop your thoughts in the comment section below. And finally, if you are trying to navigate this chaotic market, whether you are a buyer who wants to execute the perfect negotiation or a seller who needs a data-backed plan to get sold, I am here to help. Click the first link in the description to book a free, no-obligation strategy with me. We will go over your specific situation and lay out a clear path forward. Thank you for watching. Until next time, see you soon.